Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and happy Sunday. We come to you every week giving you sincere and actionable ideas that you can use to improve the lives of yourself and your loved ones financially. We don't want anybody to simply survive retirement. You need to make sure you thrive in retirement. Connect with us, 833-964-PLAN. That's 833-964-PLAN. Go out to getretiredstayretired.com. That's getretiredstayretired.com. Well, holy cow, halfway through the year is in the books. And if you would have asked me that we were going to have a new administration, well, maybe it's not new. It's simply act number 2. And we were going to go ahead and continue to have the largest land war raging in Europe since World War II. Thank you, President Putin. And you were going to see Middle Eastern tensions, the likes of which we haven't seen since the 1970s. We were going to be bombing nuclear reactors, and throw on top of that we were going to go ahead and create various forms of trade, tariffs, and other antics playing out across the globe, and we would finish halfway through the year in positive territory. I'd have to pinch myself and say, boy, am I in Wonderland. But that's exactly where we're at. And I think it comes to a very important lesson. And that lesson is you have to trust the process. Let me repeat this. You have to trust the process. And what's the process that I refer to? The process I refer to is making decisions that are data-driven. Making decisions that are data-driven, not decisions based on sentiment. Because when you make decisions based on data, it increases the likelihood that you have a probability of success. Because data is consistent. Sentiment is wide and varied because sentiment is emotions. And I've got one of our top wealth advisors in the studio with me today. David, I've been hearing that the Great Recession was coming in 22. Did it show up?
Nope.
Heard about it coming in 23. Didn't show up. Heard about it coming in 24. Didn't show up. Been hearing about it coming in the first 6 months of 25. Still hasn't shown up. So don't get me wrong. I'm as mad as anybody about how expensive everything got. That could have been prevented. I'm mad with all the things that are happening in various places. But the truth is, if you follow the process, which is data dependent, then your investment results, boy, they're pretty damn good, aren't they, David?
Yeah, I mean, it's hard to think about the disaster of March and April and how quickly things went down. I mean, I believe that we had a 2-day sell-off that ranks number 3 all time. The only times that were worse were at the peak of COVID and the 2008 financial crisis, meaning in 2 days, the market dropped significantly. But for those that were patient and held on and didn't sell in May and go away, what they experienced was one of the best Mays in the last 30 years on record. And as you pointed out, we're back in positive territory and we kind of reset the stage from here. And you know what? This kind of falls in line with our outlook that we did in January, where we kind of had dubbed it pragmatic optimism. I mean, generally speaking, we're always optimistic about the USA. But the reality is we knew some things were coming down the pipe. Now, I would say it's probably fair to say that maybe the tariff announcement was worse than maybe the worst case forecasted scenario. But again, if you followed the data, things like the jobs numbers the economy's okay. It's just that people don't feel good about the scenario, but there's a difference between feelings and hard data. And right now, the hard data is okay. It's not great, but it's good enough.
So we want to help you get retired and stay retired. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you go there, go ahead and click on the useful guides and get our 5 keys to retirement planning. That's 5 keys that you need to master if you too want to get retired, stay retired. GetRetiredStayRetired.com. Download for free your 5 keys to retirement planning. So, Dave, we've been talking about the first half of the year, and it's in the books. And you know what? The numbers are good. And the numbers are just forever away from how dark and abysmal it looked in March and April. I think we agree, and our listeners who've been tuned in understand why data-driven decisions are so much better than decisions that are sentiment. Sentiment is gambling. Data-driven is the study of probabilities. But you mentioned pragmatic optimism, David. Talk about how we can implement this theme of pragmatic optimism to continue to have success in the second half of 2025.
Yeah, when we talk about this stuff, we're just referencing data points. And so when we did our outlook in January, we had talked about some of the strengths and weaknesses that we saw. Weaknesses, higher interest rates, housing's in a tough spot, threats, certainly, tariff uncertainty, a stronger dollar. But there were some opportunities too, perhaps with tax cuts coming down the road and looser regulations. One of the things we had also suggested is we had a good 23 and 24. And typically, at least since 1950, the third year of the bull market, so it started in 23, continued in 2024, 2025 is year 3. The third year of the bull market just tends to be more moderate, right? The easy gains kind of come early on. And what we had suggested to people is this is probably a good time to start spreading out the dollars. Our stock market was expensive coming into the year. And what we needed to do is put dollars into some other asset classes to make sure that we weren't reliant on just one spot. And I think investors are finally receiving those rewards of diversification this year because we've seen a complete reversal where, as an example, foreign stocks have outperformed US in the tougher months of March and April. Dividends outperformed growth, and multi-asset portfolios are working in those investors' portfolios. And I would also add having some non-traditional investments, things like precious metals and some other alternative investments really prove their worth in those difficult markets. And now is everybody's opportunity that we're back in positive territory to say, hey, look, should we be adding more to those diversifiers? Because now is the time to add as we've just surpassed the all-time highs.
I think that's really important. You always get a second chance to do the right thing. So let's make sure you embrace that theme of pragmatic optimism, and let's implement that theme by diversifying our diversifiers. You heard it from David. I want to repeat it. Make sure you're rebalancing your portfolios back to target, which means you gotta have a risk budget. And if you don't know what your risk budget is, you deserve to find out. Again, data-driven decisions. David, risk tolerance is how we feel. Risk budget is a numerical study that quantifies our capacity for risk. And if people want to learn more about risk budgeting, they should connect with us and use our Orion Global Relay software to go ahead and determine their risk budget.
Yeah, I think that's a great point, Craig. I just want to jump in there. Risk tolerance, oftentimes in our business, brokers or advisors will give people a risk tolerance questionnaire. But to me, that's kind of a flawed way of looking at things, because when the markets are doing well, everybody has a higher tolerance for risk. When the markets are doing poorly, certainly people are less willing. Risk budgeting really fits into having a financial plan, though, right? So we're investing for a specific outcome, which is a consistent income that's growing with inflation. And I think as investors, we need to recognize that if your portfolio is allocated simply based off a 10 to 15 question or questionnaire that you took, does that really hold water when times get tough? I would argue probably not.
No, it doesn't, because you can't do tolerance and sentiment, David. You said it so well. Our number, 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're on that website, download for free our 5 keys to retirement planning. These are the 5 techniques that you need to master in order to make sure your retirement is nothing short of a tremendous success. 833-964-PLAN, getretiredstayretired.com. And David, you heard it. The bottom line is all of this is rooted in planning. You deserve to work with not a single advisor. You deserve to work with a team of advisors, a team of multidisciplinary specialists in the realm of investments, cash flow, retirement modeling, retiree health care, long-term care, taxation, estate planning. That's what we do well, and we do it well at VestGen Wealth Partners. All right, it's that time. We're going to pay some bills, take a break. In the meantime, you're listening to In the Know. Craig and David, VestGen Wealth Partners, AM 560, The Answer.
On AM 560, The Answer, where his goal is to pummel you with financial know-how until you say uncle.
Hey, welcome back. If you didn't get a chance, go out to our website, getretiredstayretired.com. That's getretiredstayretired.com, and download our 5 keys to retirement planning. Now, you believe in this president. You believe in this administration. You listen to this station for a reason. But there's a lot of people who are still crying chicken little. There's a lot of people who think the sky is falling. And don't get us wrong. I understand just because things haven't turned out to be as bad as feared is not necessarily the same thing as things being good. But I want to list out some reasons why the sky is not falling. Because again, this is about data, not sentiment. David, give us some of the reasons that the sky is not falling today.
Well, I think it certainly felt like the sky was falling in the first quarter of this year. We put up a negative 0.2% GDP number in the first quarter. So when you've got a stock market that's rolling over and you put up a negative GDP number, certainly people think this is the end. But if you fast forward, the Atlanta Fed model now has GDP forecasted at about 4.5% for the second quarter, which would be the best quarter we've had since 2021. So I don't think anyone's saying the economy is perfect, but we did put up a negative number, but it's come back very, very strong in the second quarter of 2025. So that's one reason. If we think about what are the underlying pinnings of that, this is something you talk about in the media all the time, Craig, which is although the sentiment is bad, a big part of this is the jobs data. And the unemployment data has been fairly strong, right? I mean, we're still well below the 15-year average. I think we're coming in right now around 4.2%. I think the 15-year average is closer to about 5.7. So again, while not great, it's not bad either. And with strong jobs numbers, those are typically tied very closely with consumer spending. And that's been that tug of war that we've had all year, which is people keep saying they feel poorly about the state of the world, and yet they keep spending all of their money. So they're not necessarily lining up, which is why we say, watch what people do, not necessarily what they say.
You're right. Actions always speak louder than words. And I think it's important for people to remember, do not bet against the American consumer. Don't ever bet against the American farmer, and do not bet against the American CEO, because as long as they know what the rules of the road are going to be, they're going to find a way to navigate things towards profitability. If you're just tuning in, we're talking about, again, this concept of making decisions based on data, not on sentiment. And there's too many people that have been screaming the sky is falling in 22 and 23 and 24, and they're continuing to do so in 25. But you heard David say strong jobs equal strong consumers. David, what are the other underpinnings that still support this soft economic landing that everyone's enjoying?
Well, one of the other things we've seen change is capital expenditure from companies. And specifically, where we see that is in this AI thematic, right? Of companies spending a lot of money getting their artificial intelligence up and running. And I would say earnings has been much better than people expected. We're pacing ahead of where we were in terms of growth ahead of 2022. And then if you look at the amount of money that's being spent, the amount of money that's being spent on AI has grown more than 50% since 2023. So as everybody adopts these new technologies, that requires capital, right? So that's pouring into the economy. Now, how long that will last, I'm not qualified to say, but the numbers are pretty impressive. And from an investment standpoint, I'll throw one thing out there. The price to earnings ratios and some of the valuations on some of these big tech stocks are actually pretty cheap after we had this big sell-off in March and April. So if you missed the early entry point on that stuff, I don't think it's too late. I still think we're in the early stages. So if you take a better than expected GDP number, you still have consistent job growth. You've got capital expenditure, specifically with artificial intelligence endeavors. You put those together, that's been enough to kind of hold things together. Again, not pretty, but just good enough. And what we know from history is just good enough is fine, right? Like we have talked about the last couple of years of not too hot, not too cold type of economy, just right. It's been just right for the stock market through the first half of the year, although it was a bumpy ride.
No, that's it, David. And it's exciting, guys. Listen, there's so many places to invest, but we sit in the next phase of what is a revolution, not the industrial revolution, but the AI revolution. And we're still in the early innings. And that means there's so many different ways to get involved. I think software is one example. Software is resilient. It's expansive. It's a growing sector. There is no doubt about it. And when you invest in companies that are delivering mission critical software on an enterprise level, those are companies that have great recurring revenue, customer retention, have some level of enterprise software, always spans a wide variety of what I'm going to call verticals that cater to the unique needs of various industries. That gives enterprise software some level of innate diversification. And I talk about this because I think software in particular now, it's a generational software market opportunity. There's no doubt about it. I mean, enterprise software companies have seen a valuation reset because growth is normalizing and margins are expanding. And I just think that people really need to lean further into this emergence of AI because it's a paradigm shift. Yep, I'm not overselling it, but it's a paradigm shift in innovation. I mean, look, we had traditional AI relying on specific algorithms and sets of rules. That was more focused on automating tasks. And then all of a sudden we move from traditional AI to generative AI, which might require some user prompts or guidance. But look at how generative AI, learning, data learning, machine learning, and now we're past traditional AI. We're past generative AI. We're on agentic AI. You know, and agentic AI is designed to enhance the human capability. It's operating Agentic AI operates with minimal human oversight, performs tasks on behalf of the users. It's autonomous decision making, goal-oriented actions. And if you can't tell, I'm excited. And if I'm excited, you should be excited. But you need to find ways to access it, and you need to work with firms that have the talent to get you there, not just in public marketplaces, but you gotta get there in the private marketplace, because so many of these companies are private. They're not publicly traded. And that is a compelling solution. David, talk a little bit about that unique distinction and why VestGen is well positioned to help clients get access.
Yeah, it's not one or the other. I think it's both, right? And so a lot of people, maybe even unbeknownst to them, right, in 401k portfolios, has exposure to some of those themes that you just laid out in publicly traded companies. And I think that's probably the core of people's portfolio, and they should keep it that way. But to your point, Craig, some of these newer AI companies, right, are staying private longer. I think one of the statistics I read recently was like OpenAI raised more money in its last round of funding than all of the IPOs from like the prior year combined. But they're not a publicly traded company. So how can you, as a retail investor, get access to these companies? Well, you can't buy them through a mutual fund. You can't buy them through an ETF. You have to access them through private equity offerings, which come in lots of different flavors and shapes and sizes. But if we know that those companies are going to stay private longer, perhaps we're missing out on some of the upside potential if we wait for them to go public. So if you're a longer term investor that has staying power, that can keep money in these investments over several years, these are things that people should be embracing now. And one of the reasons for that is we had a V-shaped recovery in the stock market. Early in the year, we had mentioned stock prices are a little bit frothy. The market dropped, stocks got cheaper. Stocks have now recovered. We've just edged above our all-time highs. Guess what? Stocks are frothy again. And if we want to transfer equity risk, perhaps we transfer some equity risk from publicly traded securities to private securities. And VestGen is a great platform for families to go ahead and move dollars into those strategies.
833-964-PLAN. That's 833-964-PLAN. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. If you want to understand and you want to learn more, you can and you should. Go out to our website, download our useful guide, 5 Keys to Retirement Planning, and schedule a complimentary consultation where we can explore what it means to invest not just in publicly traded markets, but those that are private equity market driven. More to come. AM 560, The Answer.
A dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560, The Answer.
I got news. As people are living longer, retirement planning is changing. Why is it changing? You know what? We have a client who's 102 years old, and he still lives independently. I mean, did you know that there's over 100,000 centenarians in the United States today? And that 100,000 number is set to go 4x. That's right, 4x over the next 25 years. And you already know why it's happening. It's better genes. It's better diets. It's better this. It's better everything. And you know what I think about is, if you have a chance to live that long, I didn't say you're going to, but if you have a chance to live that long, are you going to be prepared? And I'm not just talking about financial preparedness. That's the obvious. I'm talking about what in the world are you going to do when you get up out of bed every day and you're retired for the next 35 to 40 years? Yeah, you can't just have money. You got to have something to retire to. David, what do we mean by that?
Well, You got to have something that gets you out of bed with passion and vigor. And I think for a lot of people, they define themselves by their work, and they were really good at what they did for 30, 40, maybe even 50 years. But to your point, it's very hard to go from 100 miles per hour to zero. So in almost every situation, that's a point that comes up is we're asking that family, is there a way that your employer will let you slow down? Can you stay on as a consultant for a year? Can we go to 3 days a week? And I understand for a lot of people, going to 3 days a week still means you'll work 5 days a week. But let me tell you, from my experience in talking to folks, you can't just turn it off overnight. So I would think about that, and would think about, do you have something that you like to do? Does your spouse have something that they like to do? And are there things that you like to do together? Because we don't want to be sitting across the kitchen table just staring at each other, figuring out what we're doing or where we're going for dinner. But I think the other thing to keep in mind with this is, if you're retiring in this environment, it's scary. The word for 2025 will be uncertainty. And so a lot of folks are thinking, hey, I'm going to retire. I need to really hunker down, load up on all of these safe investments. And I think what you just outlined, Craig, is if you're actually too safe, while it might feel good for the first 4 to 5 years, if you're living till 90, 95, or even 100, we got to figure out a way to grow your purchasing power. So I don't know about you, but I just kind of went through my personal finances, started looking at things like my utility bills and stuff like that. To be honest with you, I was really surprised how quickly things have moved higher. And that's just a part of retirement. So we've got to mentally figure out what we're going to do and find these new passions and hobbies. And then we actually have to make sure that we have a documented plan on how we're going to grow the cash flow long term, because we don't want to become a fallen angel.
That's right. And don't be a fallen angel. Fallen angels are those who end up retiring early, and everything's fine for the first 15, 20 years. But all of a sudden, they get into their mid 70s to early 80s, and they're running out of money. And they're running out of money because the silent killer, which is inflation, ran them down. And notice, inflation's the silent killer. You don't realize it until it's already too late. So if you want to get retired and stay retired, and you don't want to be a fallen angel because you're not going to survive in retirement, you're going to thrive in retirement, you've got to be using our 3 pillars of retirement income. Those 3 pillars of retirement income are key table stakes if you're going to live the life that you deserve to live, which is a freedom from worry. And yes, everyone's living longer. And I know you don't think it's going to be you, but what if it is? And if it's not you, is it your best friend in life, your husband or your wife? You've got a responsibility then to unfold these 3 pillars of retirement income. And pillar number 1 is capital matters, capital matters, capital matters. Once you've retired, all that you have is pretty much all that you're ever going to have. You can't afford to give it away through poor investment decisions. So, David, when you think about capital matters, why is it so important when it comes to the sequence of returns?
Because you don't want to be forced to sell in a down market, meaning that it's fine to have an equity portfolio when you're retired. Heck, I have lots of clients that are 80, 90% equities, and they are retired and living off their income. But what we don't want to have happen is a prolonged bear market where for 6 months, a year, 18 months, stock prices are sitting at the lows. And then you need capital, and you are forced to sell those great companies at depressed prices. Your only strategy around that is to have some of the safe money ready to go before the bad stuff happens. And oftentimes I tell equity investors the price you pay to be retired is that you can't have 100% of your capital in the stock market. So I'm not saying you only have to have 50% in the stock market, but we need to figure out how much time can you buy yourself? Do you want to buy yourself 1 year of safe money, 2 years, 3 years? and keep that money in something that's easily liquidated where we don't have to worry about selling at a loss, so that God forbid what happens, you know that you can ride that out. But again, the key is there's no crystal ball in this. You've got to have that cash flow reserve account before the volatility comes. And I think that's one of the staples of everything that we do is when people are preparing for retirement, not 2 weeks out, but maybe a couple of years out, is having those conversations and saying, what do you feel comfortable with? Because what I feel comfortable with might be different than someone else. And the nice thing about investing is you can design them based off your value system and what's important to you. But that's how we get around that, is by doing it before the tougher times are here.
833-964-PLAN. That's 833-964-PLAN. Go to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Download our useful guides. One of the ones I love right now is 5 keys to retirement planning. That's the 5 keys to retirement planning that you need to master if you too want to get retired and stay retired. And as we've been talking about those 3 pillars of retirement income, David, pillar number 1, capital matters, capital matters, capital matters. But that's only good if you pair it or combine it with pillar number 2. And pillar number 2 is you need to generate sufficient portfolio income, which allows you to not touch the corpus, not touch the principal. So we're investing in a world today where you're no longer starved for income. You're investing in a world today where interest, dividends, distributions, payments, you can cash flow your retirement. And how wonderful is that, David? It's fantastic. But you know what? We're coming up on a hard stop. And David, when we come back, we're going to talk about some different ways that people can cash flow their retirement beyond simple interest from bonds, beyond the simple dividends from dividend growing companies, the great companies of America. I think we talk a little bit about real estate. I think we talk a little bit about credit and create some excitement that's consistent with diversifying your diversifiers in the second half of 2025. Listen, if you listen to this station, we're like-minded. That's important. And we want you to do well in retirement. We want you to have the freedom from worry. We want you to start knowing all that you don't know. And I offer you that when you have the chance to work with a family office for regular people, where you can be comfortable, non-flashy, family-centric, have these traditional views, and just know that you want to do better in all areas. Taxation, investment, estate planning, continuity of care, you name it. That's what we do, and we do it well. We're VestGen Wealth Partners. You're listening to Craig and David in the know with VestGen Wealth Partners on AM 560. The Answer.
Get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
All right, we've been talking about what it takes if you're going to be a centenarian. I can't help you with what to eat and what to drink, but I can definitely help you financially because it's strategies that are data-driven, that are tested in the trenches. Heck, we have a client who's 102 years old right now, and he's not surviving, he's thriving. That being said, if you're going to stick with us and you're going to have a plan, you got to know that once you retire, what you have is all you're ever going to have. Capital matters. That safety of principle becomes paramount. And David shared with us some great ways to help ensure that happens by making sure you're in a position to never sell when prices are low. That's why you have cash flow reserve accounts. So pillar number 1, capital matters. Pillar number 2, generate sufficient portfolio income so that you can live off of the dividends, the interest, the payments without touching the corpus. And in a world that used to be starved for yield under zero rate interest policy, which is no more. Let's talk a little bit about some unique ways, David, that people can build income. And one of the first ways I think about is having a diversified fund. I might call it a premium income fund. Other people might call it an equity income fund. What type of yields can we garner? And how does that help us with our retirement income in today's environment, especially if we think the stock market has muted upside for the foreseeable future?
Yeah, that strategy that you just mentioned is ideal for sideways or down markets, right? Because you were saying premium income, equity income, or maybe even like covered call strategies. And all we're doing in those strategies is, writing calls against a large cap index. But the yields that are generated can be high single digit yields. And for those that want to participate in stocks, understand that premium income might give up some of the upside. This is a great way to stay liquid in your portfolio, generate above average income that's paid out on a monthly basis. That's the key. Not all products are designed the same way. Some pay out once a year. I'm pretty confident if you're retired, you prefer a monthly direct deposit into your bank account akin to a monthly paycheck or getting paid twice a month. So when we build out these covered call strategies, we're going to have covered calls that come through and generate these dividends each month, but we're talking high single digits. We can pair that with some core individual fixed income. That's a great start. But we got to be thinking out of the box today. And as you mentioned, there are other sources that people can access. And I think one of the sources that I spend a lot of time talking with families now is things like real estate and infrastructure. And I always put it out there. I said, hey, look, I'm going to bring up something that might sound a little bit strange, but in investing, we have recency bias. Everybody knows that real estate was under pressure in 2023 and 2024. But I would argue that after that 20% decline, we're kind of through and we've already hit the bottom. I mean, generally speaking, the math shows that we're 5% off the bottom, but we're nowhere near where we were. And the way that we like to invest in real estate is really through the hard asset, not the stocks. And my rationale for that is if we're transferring stock risk, we don't want to just go buy real estate stocks. We want the hard assets. And generally speaking, with real estate today, you're picking up yields 4 to 5% per annum, and then a little price appreciation. And depending on where you're buying that, if you're buying that in a trust account, a joint account, not an IRA, there's a good chance that you're probably getting some of that as return of capital, which is a fancy way of saying you're getting some depreciation. So in many cases, that dividend is not fully taxable to you. So if you're one of those folks that understands a lot of the value in financial planning today is driven by creating synergy between your tax return and your investment portfolio, buying into non-publicly traded real estate and infrastructure is a great tool to have in your tool belt to generate consistent dividends and create a longer-term inflation hedge for some assets that have long-term staying power.
I think that's brilliant, David. So, hey, if you're in this search for yield, because you're following our 3 pillars of retirement income, capital matters, generates sufficient portfolio income to cover the monthly spend so you never touch the corpus. And of course, you have an eye on long-term growth, meaning growing your capital base over time so you can grow your income. You don't have to go just with money markets and bonds and annuities today. You can further diversify your diversifiers and work in the areas of industrial real estate. Who doesn't love all the big, gigantic concrete bunkers sitting off of expressways with 80 garage doors and semi-trucks coming in and out every single day, located off, again, major highways for that last mile delivery? That's an investable theme. Going ahead and looking at great cap rates, doing triple net lease sale leasebacks that can have strong, very strong after tax returns because of the depreciation that comes through to offset the yield, that's another idea. And don't look past the defensive characteristics of infrastructure. Gang, the world is underpowered. Listeners, everyone's underpowered if they're making a commitment to artificial intelligence. I mean, do you know how much juice it takes to run a current gen, or how much juice it takes to run a next gen, or how much juice it's going to take to run a hyperscale data center? Guys, energy is going to be the new commodity in the same way that data is the currency that is gold. The bottom line is you got to be involved in infrastructure, I think, to be a part of the new world order, the new trend that's here. And you don't necessarily have to do it with just a mutual fund. You can do it through different flavors. If you want to learn more, you can. 833-964-PLAN. That's 833-964-PLAN. Go out to our website. That's getretiredstayretired.com. That's getretiredstayretired.com. Now, David, what else do you want to add on this topic about diversifying our cash flows?
Well, I think this is a great way to link three topics together. I mentioned that very good advisory teams are always thinking 2-3 steps ahead. So where do we need to be 2, 3, 5 years from today? And so let's link this together. We had mentioned that, private real estate or private infrastructure might have some long-term staying power, long-term investment thematic, also provides some tax-efficient dividends. So someone out there who's listening might think like, hey, great, I love tax efficient dividends. I want that return of capital depreciation. But what's the catch, right? So Craig, let me ask you a question, right? So I know I eat my own cooking here. I own all this stuff myself. You buy this, you start collecting all of these tax efficient dividends. But I would imagine that these tax efficient dividends lower your basis. But if you're a long-term investor, how do you see that coming together in your plan? I mean, does that mean that if you hold on to it forever, you're going to pass this on to the kids with like a step up in basis? Is that applicable in this situation?
Listen, the tax code is full of opportunities, and the tools that can be deployed, courtesy of the intersection of research and technology, are wide and vast, and you just need to be informed of your choices. So, David, are there steps up in bases? Yes. Are there workarounds from steps up in bases on real estate like 1031 exchanges? Of course there are. Are there complementary strategies like everyone who's been direct indexing because it's the single best way to create after-tax returns by getting all of the upside of the market indices with the opportunity to tax loss harvest and book deductions into your lost piggy bank every year? So, David, I could take that 27 different ways. I think the short answer is that VestGen Wealth Partners, we believe in a pathway to yes, because a pathway to yes is a pathway to success. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com.
You want more in the No Radio? You can handle more in the No Radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
Life, it used to be simple. Retirement management used to be easier. The metaphor I use is it was kind of like a lake. You could see to the other side. That was analogous for how long you were going to live. And as long as you had Social Security, reasonably priced healthcare, you had good interest on your bonds, your CDs, and you know what? You kind of just glided across that lake and everything was fine. But I got to tell you, ever since the great financial crisis, the great reset of 0809, the analogy I use for retirement, you're no longer on a lake, you're on the rapids. And when you're on a rapids, whether it's a class 2, class 4, class 5, I got news. You can't see around the bend. You don't know what danger is going to be coming. And anybody who goes on the rapids does it with a guide. because a good guide knows what it takes to be prepared. A good guide knows where the danger spots are. And that's what I invite you to participate in. I want you to find a guide. I want you to find a collaborative relationship. I want you to work with advisors who have the heart of teachers, but have surrounded themselves with multidisciplinary specialists all under one roof, so you too can have that family office experience. That's what we do. And we do it so well because, again, our decisions are data driven. Our process doesn't rely on sentiment. We will always listen to the authenticity of your voice. We will do everything we can to see the world through your lenses. But we will deploy strategies using our 3 pillars of retirement income that are going to be designed to get you retired and keep you retired. And we want you to learn more. We want to connect with you. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. What I need you to do is request a complimentary consultation. Visit with myself, visit with David, and download some of our very useful guides, whether it's the publication and thought leadership we have in the trade war. Download for free our 5 keys to retirement planning. Those are the 5 things that you need to master if you want things to go smoothly. And we're here for you. We're like-minded. We too are comfortable, non-flashy, family-centric, have traditional values, and we want you to do better because you deserve to do better. You're listening to In the Know. Craig and David, VestGen Wealth Partners, AM 560, The Answer.